great to have you with us despite this upside that we're seeing in the after-hour session. This, of course, comes after huge downside in the regular session. This GTV chart on the Bloomberg just showing us how only about, 30% or so of the NASDAQ 100 right now remains above its 50-day moving average. So there seems to be still a lot of pressure. Where are we headed?
You're right. Yeah, it was a tough day in the markets across the board here in the United States. And, interestingly, looking back over the past year, and this is something I didn't realize until today, but the NASDAQ has underperformed the Dow Industrial Average. That said, these types of pullbacks are not uncommon for markets. And within the S&P 500, we did breach the 200-day moving average. When that happens, we typically will see a bounce, and then we'll see another test and possibly a breakthrough of that 200-day moving average before we start to clear away some of the uncertainties and then potentially move higher.
Stepping away from the technicals, though, where are these tech stocks headed, given that, of course, we continue to see these yields rising, concerns about valuations, and, of course, the Federal Reserve coming out with more hawkish views?
Sure. So certainly as rates rise, growth stocks in general that have that longer duration before you recapture the earnings relative to the price to earnings ratio, those do tend to suffer somewhat as rates rise. But that's in a vacuum. If you don't consider the fact that, earnings and revenues will continue to be attractive, in our opinion, over the next 6 to 18 months. And, that's as digitalization continues and as we experience these tight labor markets and companies are looking to technology to help them continue to produce, even though they may not be able to employ humans.
Tracy, I want to get back to the labour market in a moment, but just to your points on historically markets dealing with Fed tightening cycles pretty well, there is one important difference this time, and that is, of course, that massive balance sheet runoff. What potential impact do you think that's going to have on asset prices?
Sure. So that is going to in addition to any rate increases, that is going to tighten financial conditions. We think financial conditions will continue to be relatively attractive here this year. But you're right, the Fed has a large balance sheet. And the question really is, are they going to allow that balance sheet to be reduced passively? So bonds maturing and rolling off, or are they going to feel that they need to actively employ quantitative tightening? And, as long as they keep their options open, they watch what the data is telling them, then, the expectation is that they will act appropriately.
So turning then to the jobs numbers, which we will get tomorrow in the United States, or Friday at least, given how tight the labour market is at the moment and given the Omicron variant running loose in the US, are we going to actually learn anything useful about the health of the US economy from these numbers?
Yeah, so we are likely to see a disappointing number tomorrow. And in fact, some of the whisper numbers are even negative. That said, it is not necessarily, this 1 month number is not necessarily a reflection of economic growth or the strength of economic growth here in the United States. It's really more about the tightness of the labor market and, this Omicron surge that we saw towards the middle of January, and when workers really just weren't in the offices. They were sick or they were caring for sick people. So that just emphasized the tightness of this labor market. So two things that we think the Fed will be watching. They'll be watching, wage inflation, and stronger wage inflation could really solidify their hawkish stance. And they're going to be watching labor force participation. We don't think that's going to improve. So, that's just going to be more confirmation of this tight labor market.